Hi there, welcome to the Equity Trust Virtual Training Center. My name is John Bowens, and in this segment, we're going to answer some of the frequently asked questions that prospective self-directed IRA and 401k investors have with respect to investing in real estate and other alternative investments. Additionally, we've designed this video for you to share with your CPA, financial advisor, wealth manager, or other financial professional as you navigate and explore the concepts of self-directed retirement account investing. Keep in mind that many CPAs, tax advisors, wealth managers, financial advisors don't have a working knowledge of self-directed IRAs investing in alternative assets. They might have a lot of experience in the traditional public markets, but not necessarily in the private asset marketplace. And that's okay. We are one member of your financial team, and investing is a team sport. So allow us to help you educate your other financial professionals in your network so that you can come to a conclusion and make a good financial decision going forward. So that being said, let's jump into the first frequently asked question that we see. And that is, why would we, with respect to real estate, own a tax-deferred asset like rental property in a tax-deferred account such as a traditional IRA? Now, we can get into the difference between a traditional IRA and a Roth IRA, which is tax deferred versus tax-free Roth, which will make a difference with respect to rental property investing. But the first thing to understand is that you ultimately need to come to the conclusion yourself with regard to what is going to make the most sense for you from an investment perspective. It's not necessarily always a tax play, but rather a yield, return on investment, and security play. Many of the clients that I have worked with over the last 15 years, they're investing in real estate with their IRAs, not because of the tax advantages, although there can be some really incredible tax advantages. They're doing it because they can diversify away from the traditional public markets. And many of the clients that I've worked with over the last 15 years feel a lot more confident investing in real estate as an asset class compared to investing in the traditional stock market. So if you're an investor that has a experience, you have expertise in owning real estate in an IRA, then owning rental properties in a self-directed IRA can make a lot of sense for you. All right, so back to the tax deferred in a tax deferred account. When you own rental properties outside of your IRA, you can depreciate the property, and that depreciation and your operating expenses offsets your income. And so that allows you to put yourself into a position where you could potentially show no gains whatsoever, or no income on an annual basis. You could potentially carry forward losses, or maybe your income is very minimal, therefore your tax exposure is very minimal. Now that's great, but what happens over time is that depreciation accumulates. And then when you sell the property, that depreciation gets recaptured. Your cost basis adjusts, and then you have a much larger amount that you would have to ultimately pay capital gains tax on. Now, yes, there are 1031 exchanges and potential step-up basis if you leave your properties to your heirs, but by and large, there's going to be a taxable event. In a IRA, all of your rental income is tax exempt, and when you sell the property, there's no long-term capital gains tax. Now, traditional IRAs grow tax deferred, meaning when you pull the money out, you have to pay taxes. But a Roth IRA is funded with after-tax dollars. And you don't just have to start a new Roth IRA. You could also convert funds from a traditional IRA to a Roth IRA. And we have other training videos specific to converting from a traditional to a Roth account. So think of it from this perspective. Let's say you have a Roth IRA and you buy a rental property for $100,000 and you rent it out for, let's say, $1,000 a month. So you're making $12,000 a year. And let's assume you have operating expenses in the amount of $6,000. So on an annual basis, you're making about a 6% return. You have $6,000 going into your Roth IRA every single year, tax-free. You don't have to worry about filing a Schedule E. There's no tax documents. It's just money going into your IRA, just like a dividend payment goes into your IRA if you were to invest in a stock market-based asset. So now let's say you sell that rental property 5 years after you buy it for $150,000, making a $50,000 profit. that $50,000 is not subject to long-term capital gains tax. So you're not going to pay the 15 or 20% tax, depending on your income level, on that gain because it's in your Roth IRA. Now, once you turn 59 and a half or older and that Roth IRA is seasoned for 5 years, you can take all of that money out and you pay 0% tax. So the Roth IRA owning rental property can potentially be more advantageous than owning rental property in a traditional IRA. But going back to the very beginning of this segment, you have to look at this through your own lens as an investor. So you have to understand, does owning rental property in my self-directed IRA put me in a position to have a more secure financial future because I'm investing in an asset class that I know, like, trust, and have an incredible amount of expertise in? All right, so now that we've answered that question, let's move on to question number 2, which is investing in real estate or other alternative assets or other alternative investments. That's what AI is, triggers taxes and penalties. So we get this quite frequently as more of a fundamental 101 question. If I were to buy a property with my self-directed IRA, Roth, self-directed 401k, self-directed Roth 401k, we're just going to call it a self-directed IRA going forward. If I buy property, or maybe I make a private money loan to an investor, or maybe I invest in a private security like a private placement or private equity fund or crowdfunding opportunity, maybe I invest in a tax lien, maybe I invest in gold and silver or cryptocurrency, whatever investment it is that you make, alternative investment, your IRA is making the investment. Your IRA owns the asset. And you'll actually see, once you get into the details and as we take you through that process, you'll see that every investment is titled in the name of your IRA. And think of it just like buying a stock or mutual fund. When you buy a stock with your IRA, cash leaves the account. In return for that cash is a stock certificate. And now we're in the digital era, so it's a digital certificate. And dividend income goes back into your IRA and is tax exempt. You don't have to report that dividend income, goes into your IRA, it's tax exempt, no taxes. And then again, as we talked about, you have tax deferred growth in a traditional or tax-free growth in a Roth. Now, when owning rental properties, think of it from the same perspective. So your IRA buys a rental property, cash leaves the account. In return for the cash is a deed to the property. There's no taxes or penalties. You're not borrowing against the IRA. A lot of people have that question, or they have that misconception that they're actually borrowing against the IRA. Sometimes their wealth planner will even tell them that, hey, if you buy real estate, you gotta take the money out, so you're gonna pay taxes and penalties. That's not the case. The IRA is actually taking title to the asset. So IRA buys the property, and then all rental income is flowing back into the IRA. And as long as you're following all of the rules, then you are in a tax exempt environment. You sell the property and there's no long-term capital gains tax. We like to call this minimization or elimination of taxes compounding interest in the absence of taxation. So investors find ways to get to their retirement goals and their financial goals in a shorter period of time with their self-directed IRAs because they're leveraging the tax advantages, compounding interest in the absence of taxation. All right, so again, no taxes or penalties as long as you're following all of the rules. That leads us to the next question, which is, what are prohibited transactions? So when I say following all the rules, what are we talking about? Well, we have an entirely separate training all on the rules and guidelines. You can check that out in some of our other YouTube content. But to give you the quick overview, it's important to understand that with IRAs, there are what are called disqualified persons to your IRA. And disqualified persons cannot transact with your IRA. So who are disqualified persons? Under Internal Revenue Code 4975, which governs IRAs and qualified retirement plans, disqualified persons would include yourself, your spouse, your children or grandchildren, they call those lineal descendants, and then lineal ascendants, parents and grandparents. Additionally, any business, LLC, partnership, any entity, if you will, even a trust that's owned 50% or greater by disqualified persons is also a disqualified person. So in other words, you have to be careful if you're a real estate investor and you have LLCs and trusts and other entities. For all intents and purposes, those are going to be considered disqualified persons as well. So you can't transact with these disqualified persons. What does a transaction mean? Well, simply put, you can't buy a property using your IRA funds that you personally own. You can't buy a property and live in it yourself. You can't buy a property and rent it out to your mother-in-law or your son or daughter. You can't loan money to yourself. You can't loan money to your spouse. So they're pretty basic transactions, and for all intents and purposes, pretty easy to understand. And again, we have other training videos so you can learn more about what those are, and you can get more confident with respect to what are disqualified persons or who disqualified persons are and what the transactions are that would create a prohibited transaction. And of course, we don't want to engage in a prohibited transaction, because if we do, the IRA will be distributed January 1 in the year in which that transaction occurred. Okay, so last but not least, we have tax returns. So the common question is, what tax return do I need to file in conjunction with my IRA transactions? Well, good news is your IRA is a tax exempt entity. So most people are familiar with their IRAs and 401ks and retirement plans investing in the stock market. You buy stocks, you buy mutual funds, you have dividend payment coming in, you sell a position, cash comes back in, you have a capital gain, but you don't have to report any of that income because that income is tax exempt. All of the reporting and record keeping occurs at your custodian. So for example, equity trust, we're a custodian. So we document the transactions coming in, transactions going out, investment holdings in your account. That is the essential function of a custodian. And that's what our job is. And that's the service that we provide to you as an investor. The good news is as long as you're following all the rules, you don't have to worry about any burdensome tax returns. There's no Schedule E if you own a rental property in your IRA. If you sell a property, there's no capital gains tax. Therefore, you don't have to report that income. Now, if you take a distribution from your IRA, you have to report that income. And Equity Trust as custodian has reporting mechanisms in place to do that. And then you would have to report that on your tax return accordingly. If you make contributions, generally you have to report that as well, particularly if you're making tax deferred contributions that you would qualify for a deduction. So for all intents and purposes, in terms of the income coming in, funds flowing in and out of the account, there is no burdensome tax reporting. I'll also mention that with an IRA, the IRA avoids probate. That's one of the benefits of a self-directed IRA. Beyond the ability to diversify, beyond the ability to be able to invest in a tax-advantaged manner, your IRA also avoids probate. A quick example, I have a client out of St. Louis, Missouri, a husband and wife, that have grown their Roth IRAs from about $200,000 in 2010 to over $1 million in properties. And they have over $130,000 in annual Roth IRA cash flow that they can distribute every year tax-free. Now, their goal isn't to use the money in their lifetime. They want to leave their Roth IRAs to their children. And if their children have children, they want to leave those Roth IRAs to their grandchildren, because then their grandchildren inherit Roth IRAs tax-free. The IRAs avoid probate, and they can continue to use it for 10 years and then withdraw the funds whenever they want within that 10-year period, 100% tax and penalty free. So keep in mind that IRAs can also be really great estate planning tools or tax planning tools. All right, last but not least, I should mention that with respect to investing in real estate and investing in private securities and other types of alternative assets, that you have to work with a custodian that is going to allow you or permit you to invest in those types of alternative assets. Also, you want to make sure that you're working with a custodian that has education and expertise around those specific alternative assets. And not all financial institutions will allow you or permit you to hold real estate. In fact, most of the large financial institutions that focus on stocks and mutual funds and ETFs and traditional wealth management, they're generally speaking not going to permit you to invest in real estate. The closest you might be able to get to invest in real estate is investing in like a publicly traded real estate investment trust, which we're certainly not opposed to that or saying that you can't do that or saying it's not a good idea. But a lot of clients that we work with, they want to take more control. They want to be able to go out and buy property on Main Street and not be focused on investing in Wall Street type assets. So I hope you enjoyed this video. Again, share it with your CPA, financial advisor. Encourage them to reach out to Equity Trust as well, or check out our other YouTube training videos so that we can help you and all of the members of your financial team to get well educated on this topic. Until the next video training, keep leveraging compounding interest in the absence of taxation.